Okay, now let us start with the session 2, that is 15-day trading patterns and strategies. So here I'm going to discuss all the patterns and strategies which you will see in day trading. Before that, few things you need to remember. These patterns which I'm going to show are not holy grail patterns. That means these are not the patterns are 100% every time it works, nothing like that. It is just high probability patterns, no guarantee that every time it works, so stop loss they must. Trading is a probability, not a certainty. Trading is not an exact science. That is what I said earlier also. Trading is not like mathematics. 2 plus 2 in mathematics always becomes 4. It never becomes 3, it never becomes 5. Always it will become 4, right? That is known as certainty. That means 100% 2 plus 2 is going to become 4. But trading is a probability. That means 2 plus 2 is not necessary. It has to be 4 all the time. It's a probability. Probability means it is more like a weather forecast. When they forecast the weather, you know that it's not 100%. It's probability, right? Trading also like that. So that is why always have a probability mindset. Whenever you take a trade, never have a certainty mindset. Okay, any patterns, any setup, any strategy can fail on any given day. That is why there is something called stop loss. Stop loss is kept in trading so that your trade goes wrong, you can exit with a small loss. So never trade without stop loss. It is highly recommended to start with paper trading for a few days until you feel confidence and consistency in trading with these 15 patterns. Remember, if you are new to trading, or even though if you have experience, if patterns, price action and all some new system you are using, then you are new to that system, right? It may happen that you may get confused in the live market. Bullish pattern, you may go and short. Bearish pattern, you may go long, because it's obvious that initially you will have some confusion, right? It will take time. So that is why I say start with paper trading, and once you feel confident, you can identify patterns in the live market, then only start with a small lot size. So that is what I tell everyone, that start with paper trading. It's just like a driving school. You will not buy a new car and learn driving on its own, right? So what you do, you go to driving school, learn driving, then once you learn driving, then slowly you will take out your car and you go on the small roads where there is no much traffic. You practice it for a few days, and once you feel confident, then only you take your car on the main road. And that is how slowly your confidence builds up. Trading also same thing. Just because you have capital doesn't mean that you should become adventurous and thinking that I attended the training, I know everything. So don't think like that. Trading also takes some time. Trading also needs practice and experience. That is why start with a paper trading. The advantage with paper trading is that it's like a virtual money where real money is not there. It's like a paper money. Your account will not get affected if it's a loss. There are 3 platforms where you can try paper trading. If you want to trade in index option, Nifty, Bank Nifty option, then you can try Sensible. Sensible is the one platform where you can do paper trading, one of the good platform. If you want to trade only in stocks, MoneyBuy is good. MoneyBuy is the moneycontrol.com company, and you can do paper trading here. Then you can do paper trading also in TradingView. Okay, you can trade in future Nifty, Bank Nifty. So that is what I told you, 3 options. So you can decide which platform you want to do paper trading. With that, we are coming to the most important part of this course, that is 15-day trading patterns and strategies. So here I'll be discussing all the patterns with the strategies. Remember, pattern names are not important. Important is you have to memorize the pattern. So that is what names I have given, all the names what you can see here in yellow color, all these are names of the patterns, but I have given just my names. You can also give whatever names you want. Most important is identifying the patterns, and all patterns are on 5 minutes time frame. So you don't have to even ask me whether it's a 15 minutes, 30 minutes, what time frame. All are in 5 minutes time frame. and all charts what you are going to see is the spot. Okay, spot chart. Nifty, bank nifty, you are going to see all the charts and only spot, neither future or option chart. So all the patterns, strategies which I am discussing here, 15 pattern strategies are the spot. You may have the question how to trade in future and option looking at the spot chart. That all I will be mentioning it in ebook. Along with the course materials, you will also be getting the ebook where I'll be mentioning 15 pattern strategies for your reference. In that ebook, I made a write-up how you can trade in future and option looking at the spot chart. Okay, so don't worry about that. That you will come to know. Only focus on identifying patterns and what actually all these patterns are, where is the entry exit. So you can see that all are patterns, OD, ODR, PPT and all these are pattern names. And I have also mentioned which is the bullish or bearish. Some pattern name is same, but it is both bullish and bearish. Means sometimes it's a bullish, sometimes it's a bearish, but the name is same. Okay, some patterns are only bearish. For example, ODR means only bearish. That means you will only short. Some are both. Okay, you have to see it's a bullish or bearish and you can trade. Some are only bearish. You can see here evening star. Some are only bullish. Some are both. Okay, some are only bearish. Like that, you can see what I have mentioned there. And some patterns are based on previous day high, previous day low. Some pattern based on the first candle of the day. Some patterns are based on virgin CPR. Some patterns are based on gap up, gap down. Okay, so this is just for your reference so that you will know which pattern based on what. So with that, we are coming to the first pattern of the day, and that pattern is open drive pattern or OD pattern. What is the open drive pattern or open drive setup? For that, this pattern, there has to be 4 criteria. This pattern on the first candle of the day. First candle is what? First 5 minutes candle. That means 9:15 market opens 9:20. Based on the first candle, you can take the trade. 4 criteria I said to take this trade. 4 criteria it has to meet. First criteria, candle has to be bullish candle. Second criteria, candle close has to be above previous day high. Okay, second criteria. Third criteria, candle should have some support. Okay, candle can have a PDH support, daily pivot, it can have weekly pivot, any support, candle should have some support. Fourth criteria, candle should have room to move. That means what? That means there should not be any resistance just above the candle. Sometime you may see all 3 criteria met: bullish candle, candle close above PDH, candle have a support, but immediately there is a daily pivot or there is a weekly pivot. Then you should not take the trade. That means candle should not have any resistance so that it can move for some time. Then only it's a OD. OD pattern can be also on the red candle, not only green. For that, first candle has to be bearish. Candle close has to be below the previous day low. You can see that previous day low here. Candle close has to be previous day low. And candle should have some resistance, like either can be previous day low or some pivot. And candles should have room to move. So both are OD pattern. So now let us see on the charts how this pattern looks like, where is the entry, everything. Bullish candle, candle close above the previous day high, right? First criteria, bullish candle. Second criteria, candle close above previous day high. Third criteria, candle have the previous day high support, candle have the support. Fourth criteria, candle have room to move. That means you can see that above the first candle, there is no resistance still here. The blue color what you see is the weekly pivot, and the yellow color what you see is the daily pivot. Okay, so every chart, if you see blue color, remember it's a weekly pivot, and yellow color is a daily pivot. So take a long entry here, take profit here, because there is next resistance here. So there is a chances that price may find resistance. So entry here once first candle closed and take profit here. Now comes the most important thing, that is stop loss, right? Stop loss is the most important in trading. That's why I said you should first focus on the risk in trading. Now where to keep stop loss? I can give you 3 options. Number 1, below this pivot. Number 2 option, below the previous day high. Number 3 option, below the entry candle. Number 1, number 2, number 3. When I asked this question earlier to my other students, most of the people were saying number 3. Okay, most of the people were saying number 3 earlier. But if you ask me, my answer will be this, number 2. Why I say I'll go with number 2, not number 3 or number 1? Let me discuss it. It is true that number 3 looks very safe, right? Number 3 looks very safe because below the entry candle, entry here. So this looks safe. But in trading, 2 things you should remember when you keep a stop loss. One is risk reward. Second is it should have some protection preferably. What I mean by risk reward? Risk reward means the risk and reward what you are aiming for should be in the proportion of 1:2. That means if you take 50 points risk, if your stop loss is 50 points, then your focus should be to make 100 points profit. If your stop loss is 25 points, then your focus should be to make 50 points profit. So that should be the risk reward. Always it should be in the ratio of 1:2. You remember earlier when I was going through the contents, I discussed that in trading, even 50% of the time you are right, still you can make profit. Still you can be a profitable trader provided you follow 1:2 risk reward. Now let us see if you enter here, if you keep your stop loss here, number 1, 2 small stop loss, 1 candle can come and take your stop loss. Risk reward is good, but it's too small. If you keep your stop loss here, below the candle, look at this. This is your entry, this is your stop loss, this is your take profit. Is there a 1:2? No. This is almost 1:1, right? So what I said, you should have 1:2. Now let us see number 2, which I said below the previous day high. That is somewhere here. Entry here, stop loss here, take profit here. Is there 1:2? Yes. This is a 1:2. That is why I said I'll keep my stop loss here. So that is the reason I'll keep my stop loss here. No doubt keeping stop loss is safe here, no doubt about that. But only thing is that you don't get risk reward 1:2. So that is why my stop loss will be here. You remember second thing I said, there should be some protection. What I mean by protection? Protection mean if you keep your stop loss here, this is your protection. Previous day high is likely to act as a protection. If you keep your stop loss here, first candle low likely to act as your support. No doubt if you keep stop loss here, even below the CPR, likely to work as a support. But look at this, your stop loss is going to become a very big. Assume that Monday market opens with a bullish candle like this. If you enter here, then your stop loss should be here, because this is likely to work as a protection. That is what sometimes you see that market comes down after you enter, price comes down, and then it takes support and again start going up. That means keeping your stop loss below that protection, CPR, it can be anything. Okay, it's a better stop loss. Don't enter here first candle and don't keep your stop loss here, because you are keeping stop loss without any protection. So that is why I said stop loss here is the best stop loss, because you have risk reward, same time you have a protection of previous day high. I'm not saying that if you keep your stop loss 100%, your stop loss will not hit. In trading, anything can happen. In just like our life, in our life, anything can happen. Trading also, anything can happen. It can come down and take your stop loss. But if you lose, you will lose only this much. You will lose only 1%. But when market goes in your direction, you will make 2%. Right? That is 1:2. That means when you lose 1%. When you win 2%. That is what you need in trading. Even 50% of the time you are right, 50% of the time your trade works, still you can make profit. That is the secret of trading. That is what you should focus on. That is what professional traders focus on. Professional traders are not successful because they have some magic indicator or magic strategy. They are successful because they focus on risk reward. Whenever trade goes against their direction, they are immediately cut their position and close their trade. what a novice trader does. Why? The reason that even though trading is not difficult, that strategy and all, not something rocket science no one can learn. But still you see that most of the traders, they lose money in trading. Big money they lose. What is the reason that traders lose money? Because of the emotion. Because they trade with the emotion. As a human being, is obvious that all of us are emotional, right? Human beings are emotional. Especially we are more emotional when there is a money involved. If there is money is involved, then we are more emotional. That is what the mistake happens in trading. Since as a human being we are emotional, since our childhood we have been taught by our parents, by school, everyone, by elders, everybody, they say money is very important. You should save the money. You should not lose the money. For that, you have to work hard. Right? Money is something, it is already embedded in our mind, in our brain, that we should not lose. We should always protect it. That is what the mistake happens in trading. Because trading requires different mindset. What problem happens? Novice trader enters here. First candle, he sees OD pattern. Initially, he keeps his stop loss here below the previous day high. But as market is coming down, he removes his stop loss. Why he removes? Because he knows that if he keeps stop loss there, he is going to make loss. And as a human being, we don't want to lose money. He'll keep his stop loss here, thinking that market may bounce and stop loss may not hit. But as market is coming down, he again removes his stop loss from here. He keeps his stop loss here, hoping that market may reverse and I may save my stop loss, I may save my money. And again market is coming down. As it's coming near stop loss, again he removes it. Finally he keeps stop loss here. He keep removing his stop loss, adjusting his stop loss. Only reason because of the emotion, because of the money. No one wants to lose money, right? Now look at this. He must have kept his stop loss here. Still he has not made a loss, because in trading or anything investment, your loss is only once you book the loss, right? For example, if you bought a stocks for long-term investment, 200 rupees, and that stocks crashed to 100 rupees, already you are in loss. 200 has become 100 rupees. But if you keep in demat account, you don't sell that shares, and after 1 or 2 years, 100 rupees, that shares go back to 200. At least you can get back your money, right? That means when market is going down, even though demat account it will show minus, but it's not a real loss until you square off your position. Trading also same. Even though market is going down, until you don't take your loss, you don't square off your position, you are still in the trade. There's every chance that market can reverse and your losing trade can become into profitable. Anything can happen, right? From here market can bounce from minus MTM, again you can become a profitable. Again your MTM can come in green. That is what mistake they do. They think that last time market reversed, so let me keep my stop loss below the CPR. Last time it reversed and finally I could square off my position at the break even. I didn't make loss last time. Today also same thing happens. They think like that and they keep stop loss here. Just imagine, where is your entry? Your entry price here. Where is your stop loss? You are already into such a huge risk. And finally what happens? Your bad luck, that day market reverse and take your stop loss. Even though you kept your stop loss here, you end up with a huge loss. Initially, where was your stop loss? Here. Had you booked your stop loss, your loss would have been small, right? But instead of that, you made a huge loss. That is what known as trading with the emotion. Okay, that is a mistake people do. You can ask yourself how many times you have done the mistake. I have done the mistake when I was new to trading. When I was a novice, even I have done the mistake, and I'm sure most of you must have done this mistake, because it's obvious, because we are human beings and human beings have the emotion. But what professional traders do, why professional traders are successful? Because they don't trade with emotion, they follow rules. Okay, they follow rules. What is the rule? Entry exit rule. Once they decided my entry here, my stop loss here, my take profit here, that's it. Either market reverse, they take the stop loss and they exit, or once market goes, they book their profit. That is what they always follow. Minimum 1:2 risk reward. Whenever they lose only 1%. Whenever they win, they make 2%. And after all, How many times they need to be right? Only 50% of the time they can be right, still they can make profit in trading. That is what professional traders are successful, because they don't bring emotion, they follow the rules. They know how to control the emotion. And novice trader, they don't follow the rule, they bring their emotion. Novice trader end up with a big losses. Professional traders end up with a small loss when they're wrong. What another mistake novice trader do? One, I already told you that whenever they lose like this much they lose. But whenever they take a trade, immediately that trade goes in a positive. They see that suddenly they are making profit. They feel very excited. Another small green candle, very excited. Suddenly what happens? Fourth candle, red candle. Assume that immediately another red candle. And they get panic because already their profit was here. From here it is reversing. They think that if I don't book my profit, I will make a loss, because yesterday I made a big loss. Today I don't want to make a loss. Somehow I want to make a profit today, and they go and book their profit here. That is what happens. Whenever they book profit, they profit only small profit, and whenever they lose big. That is what the mistake happens with the novice trader, because their losses are big, profits are smaller. So now you have to do the opposite. If you want to become a professional traders, just you have to do opposite. What is that opposite you have to do? Next time when you take a trade, once you are decided, this is my stop loss 1%, take profit 2%. Either wait, if market reverses, take your stop loss, or market goes up, take your profit here. Is there any red candle, whatever it is, don't worry about that. Follow the rule. Rule says that this is where you have to take the profit or take the stop loss, and follow that rules. That is what professional traders do, and you should do that. That means whenever you are wrong, you should cut your position. At least you ensure that whenever you are right, you take 2%. Okay, so that is what trading is. Okay, this is just an example to tell you what actually happens in the market, why novice traders, they consistently lose. This is also OD pattern. Okay, OD pattern, I said it can be red candle also. For that it has to be below the previous day low. This is the previous day low, candle close below the previous day low, take profit. You decided you will take profit here. Where will you keep your stop loss? Will you keep your stop loss here above that candle? Look at this. Risk is bigger than your reward. What about this? Will you keep your stop loss here above that pivot? Because there are two protection. Previous day low as a protection, pivot as a protection. Not a bad stop loss, but risk reward is just 1:1. What I do if I take this trade, my stop loss will be here. My stop loss will be just above the previous day low. Entry here, take profit here, because I focus more on the risk reward. I'm not bothered about saving my stop loss always. I'll keep my stop loss with a risk reward, with a good risk reward plus some protection, and I'll leave it to the market, because I can't decide whether market has to go up or down, right? Anything can happen. Instead of going to the profit, it can reverse and take my stop loss. That is also possible. If it reverses and take my stop loss, I close my trade. After all, I am not looking for 100% win rate, right? I'm looking for just 50% win rate. Even 50% of the time it works, still I make profit because I'm following risk reward. That's why risk reward is most important in trading, not just a win rate. Okay, 50% is enough. I will discuss more on that when we go to the risk management, and you will see it there. Now let us discuss about the next pattern called ODR pattern, or a open drive rejection pattern. This pattern looks like a OD pattern only. Okay, little bit it looks like a OD pattern, because this pattern happens outside the previous day high, bullish candle, close above the previous day high. Sometime it may have the support also, but fourth criteria I said, candle should have room to move. Normally you will not see any room. That means immediately above the candle you will see some resistance. Then what you will do? You will not take a long trade. So that means you will not take long trade. You will look for rejection pattern. What is ODR? ODR is nothing but stop loss hunting pattern. You must have heard of stop loss hunting, stop loss hunting. What actually stop loss hunting? Stop loss hunting means big boys, smart money institute, big players, they purposefully, deliberately take the market in a place where people, retail traders, novice traders have the stop loss. because they go and take the stop loss because that is the liquidity for them. Always market is looking for liquidity. Liquidity means, suppose if there is a big buy order here and if there is a big sell order here and market opens at 9:15, most of the time market wants to go here or market wants to go here. Why? Because this is where liquidity. That means you should know where retailers keep the stop loss. So that means if market comes here, you can see the action. So that is where market most of the time keeps going looking for the liquidity, where there is a liquidity. Okay, now where is the liquidity? Liquidity below the first candle. Stop loss is here. People have the stop loss. How to know people have the stop loss? That is what the retailers tendency, right? Most of the time retailers have tendency to keep stop loss below the entry candle. If they take entry here, long entry, the stop loss most of the time here. And most of the time stop losses above the day's high or below the day's low, or above the first candle or below the first candle. If it's a bearish, then mostly it's above the first candle. If it's bullish, then below the first candle. Tell me one thing, if you want to go long trade here, if you take a long, if you place a buy order here, what's your stop loss? Stop loss is a sell order, right? That is what, whenever you are buying, you are placing the stop loss is the opposite. If you are short selling, then your stop loss is a buy order. So big institutes, big players knows this is where people have the stop loss. This is where there's a big sell order. You know what they do? Instead of taking up, they will take market down, 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 and they come and hit the stop loss. They know that that is where big sell order. Once that stop loss order triggered, you can see a big collapse or a big crash. So being a professional trader, what you should do, you should not enter here. You should enter short here. Novice trader enter long here on this candle. Professional traders enter short here. That means professional traders wait for stop loss to get triggered. Once stop losses get triggered, they will short. So that is what you should do when you take this trade. Sometimes it may happen that below that breakout candle, there can be previous day high as a support, or there can be a daily pivot, there can be weekly pivot. You can ignore all these supports. Why? Because this is a very powerful pattern, ODR, open rejection. Most of the time it can break everything. Only time you should not take the trade, suppose breakout happens and immediately there is a CPR below it. Okay, then don't short. This is 31st August. Market opened with a huge bullish candle. There is a daily pivot, there is a weekly pivot. Blue color I said is a weekly pivot, right? What I said, candle if doesn't have room to move, immediately if there is any pivot, you should not go long. Instead of wait for price to break the first candle low, because that is where people have stop loss. So third candle broken the first candle low, and you can see that there is a big collapse after that. So this is the place you will enter short. This is the third candle you will short. Okay, don't short second candle. This is not a candle to short. This is the candle to short, because that is the stop loss entry. And all long traders got trapped and all the stop loss get triggered. So you can enter here, you can keep your stop loss above that entry candle, take profit at the CPR. Look at this. This is, I think, November 7th. Okay, this is the November 7th. Look at this candle. Looks like a perfect OD pattern, right? Bullish candle above the previous day high. It has a daily, it has a weekly pivot plus previous day high as a support. Next pivot is here. Next resistance here. It looks like a perfect OD pattern. You may think like going long. Stop loss below the previous day high. Take profit here. But you know what happened? It went, faced this red candle, resistance, reversed. Now what is this red line actually? What is this red line? If you remember, I said in the first session, you should mark important support resistance like swing high, swing low, supply zone, demand zone, gaps, everything. So that is what this red line. This red line is nothing but swing high. Swing high on daily time frame. Let me take you to the daily time frame and let me show what actually that line was. Look at this. Can you see this red line? That is what the swing high. This is the swing high. Okay, this is the swing low, extreme end where you see the spikes. So I seen that price coming near the swing high, and I marked that red line before market opens. I knew that that is a resistance, and that day exactly that is what happened. It went here, reversed. Where people had the stop loss, people had the stop loss below this green candle, below the first candle. Stop loss triggered, small bounce, and finally near the CPR where you can take your profit. So that is what ODR pattern. ODR pattern means it looks like a perfect bullish candle. It looks like market is going to go up, but instead of going up, it reverses and it traps all the traders who were buying in this candle. Their stop loss get triggered. And another thing, if you watch it closely on this day, can you see the CPR? Look at the CPR width, very wide CPR, right? Wide CPR mean what I said, less chances of trending day, higher chances of sideways day. That is what CPR can sometimes help you to know whether it's a trending day or a sideways day. So many traders must have thought, looking at the previous day's price action, such a bullish day, they also must have thought today also will go like this, but they don't know about the wide CPR. Wide CPR mean likely sideways day. That is what happened. Okay, so this is the ODR pattern. Slightly looks like a OD pattern only, but it's a reversal pattern. That means in the OD pattern you will take a long trade here. In the ODR pattern you will short here once first candle low is broken. Now let us discuss about the next pattern called PPT pattern or pivot pressure trade pattern. Okay, this is the pattern. Let us discuss here. What is this pattern actually? This pattern is based on CPR. This looks similar to OD pattern, like you can see the first candle, entry on the first candle, or entry on the first candle if it's a bearish. But only difference is in the OD pattern I said first candle has to be above the previous day high or first candle has to be below previous day low. But in this pattern, first candle will be inside the previous day range. That means between the previous day high and previous day low. So in this pattern, inside the previous day range. In the OD pattern, outside the previous day range. In this pattern, first candle, just like OD had, it has to be bullish. Candle close has to be above the CPR here. And third thing, candle should have CPR support and there should be room to move. But only difference here between the OD and this pattern. In the OD I said if there is a daily pivot, weekly pivot, don't take the trade. But in the PPT pattern, even though there is a daily pivot, weekly pivot, you can ignore it because your take profit should be PDH, previous day high, or take profit should be PDL. Okay, only time you should not take the trade if PDH is very near. For example, this is a PPT pattern. You enter here, but you see that oh, immediately there is a PDH and your stop loss is here. Stop loss is bigger than your take profit, so don't take the trade. Okay, if there is a pivot, then it is fine. And also you can see that I mentioned in all my patterns, take profit also can be, target can be 2R. What actually I mean by 2R? Many people think that 2R mean it may be R2 pivot, second resistance. No. 2R means it is nothing but 1:2 risk reward. That is what I said, right? Risk reward is most important. At least ensure that your risk reward 1:2. 2R means 1:2 risk reward. But professional traders normally they don't use the term 1:2 risk reward. In a simple way, they use word like 2R, 3R, 4R, 1R like that. Okay, they don't use the word exactly 1:2, 1:3 risk reward and all this. That means suppose you're taken an entry here, first candle, your stop loss here 50 points, right? From here your stop loss 50 points. Suppose market started going up, going up, going up, and somewhere here you booked your profit. You made 100 points profit. How much is your risk reward? How much was the risk? 50 points. You made a profit of 100 points. That is 2 times of the risk, twice the risk. That is what 2R means. Risk is 50 points, you made 100 points profit. That is, you made 2 times your risk. That is what 2R. Suppose you are not booked profit at 100 points, you book profit at 150. How much it is 3 times of your stop loss. You should say I made 3R profit. Suppose you booked your profit here 200 points, then you will say I made a 4R profit because 4 times of your stop loss. Stop loss was 50 points, you have made 200 points profit. Suppose you cut your position here, 50 points profit you have taken. Then what you will say? 1R. That means your stop loss and take profit is same. So that is what 1R, 2R, 3R, 4R. That's why in all the patterns you will see me showing this 2R, 2R. That means ensure that either your PDH is hit or 2R. Sometimes it may happen that you have taken a long trade and by the time it came here, already you made 2R. Your stop loss was 50. You made 100 points profit, 2R. In that case, if you want, you don't have to wait for PDH. You can book your profit. This is what very important. Okay, in trading, focus this risk reward. Now PPT trade, PPT pattern is this. You can see that this is the CPR on 6. Market opened with the first candle I said entry, bullish candle, candle close above the CPR. You go and take an entry here. You keep your stop loss below the CPR. Take profit I said previous day high, not at the next pivot. Or 2R, whichever comes first. And why I say you should keep your stop loss here below the CPR, because if you enter here and if you keep your stop loss here, you are not keeping stop loss below the protection. What I said, stop loss should be below the protection. Protection is still here, right? So there is a chances that even though market comes down, it can take the support and it can go up. Okay, so that's why safe stop loss is below the CPR. Look at this. This is also PPT pattern. This is your CPR. Day's first candle, bullish candle. You will enter here. You will keep stop loss here. You will take profit here. This is what PPT pattern is. Now let us discuss about the next pattern called evening star pattern. What is the evening star pattern? Evening star pattern is bearish pattern. That means it is like a OD pattern where first candle will be above the PDH, but only difference is on the OD pattern I said first candle has to be bullish candle, but in the evening star setup pattern first candle will be bearish. But that doesn't mean that bearish means you will go and short here, because there is a previous day high support. You should wait until that previous day high broken. Once it is broken, now you can short. This is the candle you can short. It can be second candle, third, fourth, doesn't matter. The candle which breaks the previous day high, you can short. Sometimes it may happen that first candle itself is big candle and we broken the PDH. Then you can short the first candle itself. The candle which breaks the PDH, you can short, take profit at CPR or 2R. Okay, you can short here. Once CPR is touched, you can take your profit because chances of bouncing from CPR is higher. Look at this 18th. It opened with a huge red candle, but what I said, don't short until previous day high broken. Fifth candle has broken the previous day high. Now you can short, take profit at the CPR. So this is the evening star pattern. Mean it opens with a gap up, wait till PDH is broken, then you can go short. Look at this. This is also, you mark your previous day high and you short here. Will you short here? First red candle? No. Why? Because candle still taking support at the previous day high. Second candle, third, fourth candles could not break it. Fifth candle broken the previous day high. Now you can short here. You can short here, take profit at the CPR. Okay. Remember another thing, this line, black line, what you see, this is the black line, that is called a breakout line in trading. Breakout line means where breakout happened. Previous day high was a breakout. Once previous day high broken, what I said, that support got broken. Previous day high was a support, that support got broken. In trading I said, once support gets broken, it becomes resistance. So that same black line, price came here, faced the resistance and reversed. Next time once breakout happened, remember that breakout where it happened here. And then price rebounces to that line, doesn't mean that you should take a long trade because you are seeing the green candle. Chances of reversal higher because that support likely to work as a resistance. Don't go long here. next time just because you see the green candle, because there is a breakout line. Another thing, ignore this moving average and all this. Okay, you may see red, blue and all this. In this patterns, I'm not using moving average. It will be there on my chart, but you don't have to think what is this moving average, how I take use of it. Moving average, I use it occasionally on specific days, that I'll be discussing when we go to the moving average section. But now you don't have to worry about this moving average, just ignore it on your chart. If you are interested, what is this? This is 200 EMA, this is the 20 EMA. Other than that, you don't have to worry. Moving average, you can just ignore it. Now we'll discuss about a pattern called morning star pattern. Morning star pattern is opposite of evening star pattern. That means in the evening star pattern, I said this is your current day CPR, right? This is your previous day high, this is your previous day low. If market opens with a small gap up and it makes a bearish candle, don't short, wait for previous day high to be broken. Once it is broken, you can go short, take profit here. So morning star setup also just opposite. That means market opens with a gap down, don't go long, wait until candle breaks the previous day low. Once previous day low is broken, this is where you can take long position, book profit at the CPR, because after that there is no major resistance until the CPR, right? So that is what morning star means. Green candle gap down once it breaks the PDL, just opposite of evening star pattern. Look at this. On 10, market opened with a huge gap down because previous day close was here. There was some news, I think, that's why market opened with a big gap down. But first candle only made a bullish candle and broken the previous day low, and this is where you can enter, take profit at the CPR. Here also same thing, market closed here, again maybe some news came in the market, market opened with a big gap down, but first candle only broken the previous day low, you can enter here, take profit at the CPR. That is what morning star, just opposite of evening star. Okay, one thing you should notice it, many people ask me when I say CPR is the very important, where market most of the time reverses, they ask me which CPR is important, top CPR, central pivot, bottom CPR. For them, my answer is there is no way you will know which CPR is important, will act as a support resistance. It can be any, it can be top, it can be central, it can be bottom. So there is nothing like, trading is not like astrology where you have to do the prediction. Whenever it comes near the CPR, be ready to take profit because it can reverse from anywhere. Look at this. On 9, you can see that every time it came near the central pivot, it took the support. Every time it came near the central pivot, it took the support and bounced. Here it bounced, right? So that means on 9, central pivot worked like a strong support. But what happened next day on 10th? It didn't even reach the central pivot. It came, touched the bottom CPR and reversed. If you thought previous day central pivot worked like a important levels, today also I will book my profit here, you would have missed all your profit, right? Look at this chart. You entered here, right? And you thought, oh, last time it reversed from the bottom CPR, today also I'll take a profit here only. And what happened? It went all the way till the top CPR and from there it reversed. So that is why sometime it can be bottom, sometime it can be center, sometime it can be top CPR. So what I do, once I see it came near the CPR, I'll be ready to book my profit because it can reverse from anywhere, right? So that is what you can do it. So trading is more about entry, exit, keeping the stop loss, keeping the profit target. Either take your stop loss once stop loss hits or once profit target hits, book your profit. Okay, now let us discuss about the next pattern, that is Virgin CPR reversal pattern. Okay, Virgin CPR reversal pattern. What is Virgin CPR? We already discussed in the first session. Virgin CPR means if that CPR which doesn't have any candlestick inside, such CPR is called Virgin CPR for the next day. So next day what you should do? You should go and mark a box, that means that is the support and resistance on your chart. Along with the current day CPR, that day you will have another support resistance, that is virgin CPR. And you look for the price action. You will see bearishness inside that virgin CPR. You can short this candle. You can see that next day market opened with a bullish candle. Doesn't mean that you will go long, because there is a virgin CPR resistance. Same time, it doesn't mean that you should short here just because there is a virgin CPR. Wait for some candle confirmation. This is the candle confirmation. You can short. You can keep your stop loss above that virgin CPR. Take profit at current day CPR or 2R. Okay. If there is no current day CPR, for example, instead of CPR having here, current day CPR is here, then you will take profit at 2R because CPR is there, right? You will short here, stop loss here. Once price moves 2R, you can take that profit. On 20th, there was a virgin CPR, okay, and it is a very wide. I said wide virgin CPR mean very powerful, right? So market opened with a gap down, and you can see that CPR is here. It looked like it is going towards the CPR. It's making bullish move, then huge bullish candle. Many people must have went long here thinking that market will go like this, but what happened? It reversed. Why it reversed? Because there was a virgin CPR, right? So you should have shorted here near the central pivot of virgin CPR. You could have kept your stop loss above that top CPR. Take profit back to day slow or 2R, wherever it is. So that is what virgin CPR is. That means don't go long even though you see bullish candle. Wait for a bearish candle to short. And you can see that 20th also had a virgin CPR. Next day what happened? You can see that market came here, started facing resistance and started going down. So that is what virgin CPR. You can see here 23rd there was a virgin CPR. And you can see that first candle itself is a bearish candle. In that case, first candle only you can short. You can short this candle, take profit either 2R or CPR, because there was a virgin CPR and it is making a bearish candle. That means resistance in the first candle only, candle face resistance from the virgin CPR. Immediately you can short that candle.